opening quotes for this week contrast growth from business enterprise with future contraction that necessarily comes from borrowing against future earnings. In this week's video, we observe the tale of these opposing forces acting on the market. The renewal of business optimism has led to economic growth, but concerns about debts are also affecting the market. Strains of the debate begun by Hamilton and Jefferson are manifest in the markets today, albeit those in the debate show less perspicuity, civility, eloquence, and cogent logic. Our purpose is to impartially observe the market results of policies and not to opine on the merits of political parties. We open with a surge in business optimism that led to economic growth that we're going to cover in this video. The National Federation of Independent Business publishes this Index of Business Optimism, which turned sharply upward in November of 2016, reminding the viewer that we are relaying facts and not opinions or endorsements. The stock market surged as well. Earnings growth is what drives the stock market. The surge in business optimism led to investment, jobs, and consumer confidence, which led to earnings growth. To put the post-election stock market surge in historic context, this was the third largest increase in the stock market post-election since World War II. The United States is the largest economy in the world, so it is not surprising that a resurging U.S. economy would lift the economies of the world. This chart shows the Global Manufacturing Purchasing Managers Indexes by country. This is a survey of purchasing managers' estimates of business conditions, including customer orders, hiring, supplier delivery speeds, inventories, and order backlogs. As you can see, nearly all countries are in expansion. This week, the Institute for Supply Management survey results came in at 58.7%, which indicates strong economic expansion. The Federal Reserve Bank of Atlanta, one of the regional Federal Reserve banks, produces its GDP Now estimate of GDP growth. This week, the Atlanta Fed estimated Q2 GDP at 4.7%, the highest reported number since 2011. Business is growing, wages are increasing, and workers are benefiting, as we'll see in spending on consumer discretionary items later in the video. Now we come to an opposing force in the market, or the hidden hand or hands moving the market, especially if you include the Treasury's weak dollar preference and the Federal Reserve's activities. Debt is an opaque weight on the market. The Federal Reserve is trying to unwind quantitative easing from the Great Recession in what we call QT, or quantitative tightening. The tightening in this case is the sale of assets, namely treasuries and other securities that the Fed purchased to prop up the economy and markets during the recession. This chart shows the unwinding of the assets on the Federal Reserve's balance sheet in blue, and the yield or interest rate on the 10-year treasuries shown in orange. Note that the total assets are on the left scale, and the treasury yields are noted on the right scale, and the scale is inverted. The purpose of this chart is to show the correlation between the Fed dumping treasuries and declines in the market. If two elements have a relationship where a change in one results in a change in the other, we say that the two series are correlated. A perfect one-for-one move, or perfect correlation, is +1 or -1, reflecting whether the direction of the relationship is positive or negative. Looking at these correlation numbers, you can see that there is a nearly perfect negative relationship where 87% of the movement in yields on the U.S. 10-year note are related to assets rolling off the Fed's balance sheet. And of even more direct importance to us is the same activity is 66% correlated with declines in the S&P. To understand how the actions taken as a result of our present debt predicament flow through the market, we'll follow the breadcrumbs of a few recent headlines to understand 5 factors impacting yields. All of these should be thought of in the context of supply and demand for U.S. Treasuries. As we showed on the previous slide, the Fed is unloading Treasuries from its balance sheet. There's an overabundance of supply, which causes yields to rise. Strong economic data results in investors seeking growth in stocks versus bonds early in the cycle. Note the headlines here and here. This also increases supply and again causes rates to rise. As economic conditions strengthen, The Federal Reserve also raises rates and yields also rise, resulting in even more supply. As you saw in last week's video, the government's deficit spending is financed by selling treasuries to finance our debt, again increasing supply. Note the recent headline about the Social Security Fund. Expenses are exceeding revenue, and the trust now has to sell treasuries that it holds in reserve to continue to pay benefits. Creditors become concerned about rising debts, which also causes yields to rise. The U.S. economy has led the recovery, causing the Fed to lift rates before the rest of the world's central banks. Now the ECB is beginning to discuss raising rates, and this means more supply of sovereign debt, and initially the reaction is a rise in rates on all sovereign debt, exacerbated by concerns over the levels of sovereign debt, such as the concerns over Italy last week. Eventually, a dispersion of yields around the globe may slow the rise in U.S. yields if fiscal concerns don't come to the forefront first. Last is the clincher. As interest rates rise, payments on our debt become larger and larger, crowding out other spending and becoming a danger. Now that we understand the factors impacting yields, let's see what the players are doing behind the scenes to delay these problems and how it affects the markets. We understand that the problem is debt. We also understand that we finance our debt with treasuries, and now we understand the factors that influence the interest rates that we pay on our debt. Now let's gain an understanding of the problems presented to the Treasury and the Federal Reserve. The problems are already high and increasing debt. Continuing to spend requires going deeper and deeper into debt. At a time where there is reduced demand to purchase the debt we're trying to sell, this causes an increase in yields to make the sale of the debt more attractive to investors. But the Fed can't let rates rise too fast. We saw that the Fed's sales of debt are highly correlated to declines in the stock market, which could slow the economy or cause a recession. There's also a concern over rising interest rates, making the payments on the debt bigger and bigger the deeper we go into debt. So what is the solution to delay or put off the consequences of the debt, while everyone hopes for legislators that will try to rein in profligate spending? A temporary solution would be to increase sales of shorter-term bills on the front end of the yield curve. Take a look at the change in duration of the debt being sold by the Fed on this chart. You can see the increase in sales of bills or shorter-term debt by looking at the increases in these blue bars. Many of these factors and actions result in a weaker dollar in an attempt to create more demand for shorter-term debt, slow the rate increases that make our debt harder to pay, and avoid a yield curve inversion, which reliably precedes recessions. Regular viewers will recognize this chart as well. This is a quarterly chart of the US dollar going back to 1973 that shows the dollar's long decline. These vertical green lines mark peaks or highs in the dollar. Each of these peaks marks a cycle high. The vertical red lines mark lows in the dollar, and each of these lows mark a cycle low in the dollar. By drawing a downtrend line connecting the cycle highs, we can see that the trend is down with lower highs. The recent strength in the dollar appears to be a shorter-term counter-trend in a much longer downtrend going back to 1985. Recently, the dollar ran into resistance around 95 and began to reverse. Time will tell, but the preference of the Treasury for reasons we just covered is for a weaker dollar. Now that we've looked at the strength in the economy and debt impacting rates, we can review the evidence in the market to find investment opportunities. Opportunities, it seems, would be tied to a weaker dollar, higher rate, and inflationary growth assets. If you're a regular viewer, this should also be a familiar slide. This chart shows sector performance across the top relative to the business cycle, represented by the orange line in the middle of the chart, and the financial cycle in blue. The phases of the business and financial cycles are listed across the bottom. Since we are close to mid-year, we'll use 6-month sector performance to determine where we are in the cycle. The strongest performing sectors in descending order are technology, cyclicals or consumer discretionary, services, basic industries, and energy. Industrials are still suffering from unresolved trade concerns, but stand to benefit from their resolution and from continued dollar weakness. Financials are still a bet on rising rates, but also the spread between the short and long-term rates. Given the tools the Fed is using on the short end, better growth factors are in place for the regional banks. The worst performing sectors are utilities and staples, which are bond-like and are performing as expected in a rising rate environment. You can clearly see where we are in the business and financial cycle by looking at the cluster of strongly performing sectors on the upper left. We're here, and you can follow the dotted line down for its intersection with the business cycle. The Princeton business cycle is 8.6 years long, which suggests that there are several years left in the expansion. Remember that performance reflects trends that are already well underway. These are not recommendations. Good entry points are often created during significant dislocations versus chasing performance late. Now we're going to shift to the charts and the week ahead. You should always review your previous work and see how things actually turned out. Last week we posted this chart with the trading range shown in gold. Our model scores showed a higher probability of a breakout to the upside of the trading range and a lower probability of a move to the downside. Let's see how we did. Here's the same chart with this week's data on it. Here's the same trading range shown in gold and the same false breakdown. You can see that we were correct about the probabilities favoring a breakout above the box, which we got here. Price came back down and tested the top of the box as support here before continuing higher. We posted a similar version of this chart for the S&P 500 index itself on our Twitter account, along with a price target. For more of our research, you can follow us on Twitter using the handle displayed in the green box at the lower left-hand side of the chart. If you don't have a Twitter account, you can simply Google @CaliberCap to see our research. We're going to start including this 1-hour chart of the S&P as a recap of the news of the week and market performance. You'll notice that we added the daily change in the market across the bottom of the chart, and we'll cover select headlines that impacted the market across the center of the chart and provide year-to-date, month-to-date, and weekly performance in the box on the lower right. As you can see at the bottom of the chart on Monday, the market closed up almost half a point on follow-through from very strong jobs data reported on Friday. On Tuesday, we had strong ISM data, while the market still had to digest trade concerns and yields. On Wednesday, we had the highest GDP estimate since 2011, and the market rose 0.85%. On Thursday, we sold off as Fed rate policy and dollar strength prompted emerging market concerns and a flight to safety in treasuries and select value names. The market recovered toward the end of the session to close almost flat on the day. On Friday, the market opened down on overnight remarks from Trump escalating trade tensions ahead of the G7 meeting. The market recovered through the day, but was unlikely to see traders taking significant risk ahead of a busy week. The Federal Reserve will hold a press meeting with a rate decision and policy guidance. The ECB will also meet next week and will likely announce an intent to begin tapering towards the end of the year. We get an inflation readout next week as well. On the international and political front, we have the North Korean summit and the Inspector General's report due out next week. With all of these important events next week, the market is understandably in wait-and-see mode as we wait for what will really amount to significant policy insights that will impact the market for the next 12 to 18 months. As of 2:30 p.m. on Friday, the market was up 0.21%. Looking at a daily chart of the S&P, we've added two momentum indicators, RSI at the top and moving average convergence and divergence, or MACD, at the bottom. These show the speed of the rate of change in price. RSI is rising, and MACD is also rising. Price rose to this level of overhead resistance, and with summits, policy statements, and inflation data keeping the markets on hold to next week, the market will consolidate until things become clearer. At best, with good news, we could expect a path like this: a pullback to support, a bounce and a look above resistance, a throwback to retest the resistance level, and a successful retest and continuation on to test the January highs, with resistance becoming support. This would require a lot of positive news next week, like a breakthrough with China as a result of the president's assist with ZTE, or a positive development with our G7 partners. Again, this is an ideal path that we'd like to see. It's not even a probability-based forecast. The probabilities of forecasting the market week to week are quite a bit lower than evaluating the longer-term trend, which remains positive. This is another daily chart of the S&P with Bollinger Bands and the Commodities Channel Index at the bottom. Starting with Bollinger Bands, the dashed blue line is the 20-day moving average, which is the center line of the Bollinger Bands. The solid blue lines are two standard deviations above and below the moving average. In strong bullish trends, price tends to walk the upper band and stays mostly above the dashed center line. Coming out of the correction, price reclaimed the center line in early May, retested it, and is now walking the upper band, and the center line has an upward slope. The current behavior of price looks more like this bullish period from last year than the correction period where price was mostly below the center line was mostly down, making lower highs and lower lows, and even spent some time walking the lower band. The current price action on this chart is more bullish than bearish. The Commodities Channel Index at the bottom of the chart can also give us some clues as to the probable path of price. Notice that the indicator is making a steady series of higher lows and higher highs. The size of the peaks is also steadily increasing, which also points to steadily increasing bullish price action. We can use moving averages for additional visual cues about the probable path of price. In strong uptrends, price is above the moving averages. The moving averages are up, and there is good spacing between the moving averages. When price rises far above the moving averages at an accelerated pace, particularly after a long run, the market is getting overextended, just as we saw before the peak in late January. In a downtrend, even a short-term one like the current correction, price drops below the moving averages. The moving averages have a negative slope and cross over. For the uptrend to resume, we have to go on to make a series of higher highs and a series of higher lows. The moving averages currently have a bullish look consistent with the resumption of an uptrend. The market is a mechanism for discounting future cash flows. Events next week or at any time could change this outlook, but we trade on the evidence and the calculated probabilities of what's on the charts today. While this is not a chart that we use in the model, just visually looking at the price action in the green circle, you can see that the price action is currently bullish. No one chart can give an overall assessment of the market, which is why our quantitative model uses over 400 data points collected on the health of the market each day. We'll close with this chart. Longer time frames are more predictive of the long-term trend. Looking at this weekly chart of the S&P, using price and moving averages, you can see where trouble started here, and you can see where recovery started here. We emerged from a sideways period of consolidation, shown by the gold box, and began a bullish trend within a rising channel, formed by this green support line and bounded by this overhead resistance line. You can see that there's a yellow center line in this channel that we're currently above and testing. There's white space above this line waiting to be filled if news and global developments cooperate, and the next overhead line of resistance starts at 279 to 280. Every day we measure hundreds of data points to gauge the health and strength of the trend in the market. With our disciplined approach, we allocate to growth and defensive assets according to the strength of the trend, while keeping risk measures in place to protect capital. With significant market-moving events next week, a long-term, model-based view helps us with increased probabilities of favorable investment outcomes. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.